Welcome, investors. The Fed decides not to cut interest rates because the U.S. economy is stronger than expected. But if the U.S. economy is so strong, why are they going to cut interest rates in the first place? Next, we're going to get into the Fed saying that they're fairly certain that housing inflation and housing prices are going to come down. And we're going to discuss why they're going to come down and why they are fairly certain they're going to come down. So today we're going to get into Fed Chief Jerome Powell's press conference. We're going to play a couple clips and we're going to try to analyze exactly what he's telling us, because they control interest rates, they control monetary policy, which affects the whole U.S. economy, businesses, consumers. So without further delay, let's get into a few clips.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective.
All right, so the Fed, we have to understand this. The Fed has a dual mandate, and for illustration purposes, I'm going to use this quarter so we can understand what they're dealing with. So on one side, let's say we have heads. This is stable prices. This is bringing inflation down. And on the flip side, we have tails, which is maximum employment. This is the economy. If the economy's strong, we have maximum employment, jobs are good. If we have a bad economy, unemployment goes up, and they're failing their mandates. These two sides of the coin, and they are kind of, right now, they're fighting against one another, right? We're trying to bring down inflation, and in order to bring down inflation, we have to slow down the economy, and they have to find this balance, or either they overshoot, bring down inflation too much because the economy really slowed and it's weakening. That's why inflation has come down. Or unemployment remains as low as it is right now, but inflation is too high. So they have to get this balance. And here's what they have to do. They have to stop it right in the middle, balanced. I don't know if you can see this, but I'm going to back it up. This took me a few takes, okay? I'm just going to be straight up honest with you. Boom, they have to catch it. Now, what did they tell us in the end of that clip? Bringing down inflation is their number one. So they're going to lean on the side of heads, which is the price stability. And if they lean towards that side, the likelihood of them catching it is very unlikely. So we just got to understand that they're going to err on the side of defeating inflation. So there's a chance that inflation could tick back up. Just, you got to expect them to keep interest rates higher for longer because it is imperative that they bring down inflation. What does the Fed think now? The Fed believes that they don't need to hike interest rates anymore. They are likely at the highest point that interest rates are going to be for at least the next year and each subsequent year after this, unless some kind of black swan geopolitical event where it causes inflation to go back up. So let's move on to our next clip.
We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate.
So this one's interesting. They're saying, the economy's strong right now, and they don't need to raise interest rate anymore because inflation's coming down. But why do they feel it's appropriate that they're going to cut? Because if the interest rate, or if the economy is strong and the economy can handle these interest rates, they wouldn't need to cut. They would leave interest rates where they are today, and the economy would flow as usual. And then, if with higher interest rates, if we have a recession later, something geopolitical, they could cut rates, and that's a weapon they use to bring down inflation. So if inflation is coming down, they wouldn't need to cut. However, they just said that if the economy develops as they are expecting, which means a continued slowdown, and think about it, we have a slowdown coming, they're expecting it, that's why they're going to cut rates, that's why they're talking about cutting rates. Markets are at all-time highs. So what the Fed is going to do in markets right now are not aligned, and as we move into the future of this year, that's when we should start to see, okay, the economy is slowing down. It is slowing down. But they're going to try to make sure it doesn't get too slow, which is that balancing act that they have to do. And you also heard he also repeated defeating inflation is the most important thing. And throughout the entire Fed meeting, that was the continued theme, is they are more worried about inflation than they are of a bad economy, because they have tools to take us out of a bad economy. All right, let's listen to the next one.
That reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks.
That is exactly why defeating inflation now is the most important thing. Because, I mean, some of you folks watching this video, and we see our age demographic, not most of you, but some of you were around in the 70s when there was a decade-long battle with inflation. So if we don't defeat inflation now, where rates at right now, if inflation starts ticking back up, we have to go even higher with rates. More pain into the economy and a longer sustained fight. Do we want to fight inflation for the next decade? Absolutely not. So it's imperative that we defeat inflation today. Well, not today, but this year. Okay, we're going to move on to this next clip because it's going to give us in the minds of the Fed. So they make all these projections for the next 1, 2, 3 years. And you'll notice a theme when they make these projections. They never really play out exactly as they projected. And this was a good question, and it reveals the hand, and it reveals what the Fed actually knows and can say, because we hold these folks on a very high pedestal, and they're doing the best job that they can, but they're not fortune tellers, and it's important for us to understand that.
In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about why might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
Okay, I'm going to pause real quick. I'm going to give you an interpretation of what he just asked. In their projections, 2025, 2026, they had a higher interest rate expectation by 0.25%. That's all.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question, I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. I mean, my instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long-run rates that were at or below zero in some cases. I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And
He's just telling you we're kind of guessing. We're not really sure. I mean, we're trying to stage a plane coming in and have this soft landing take place. But after that, it's tremendously uncertain, because if they overshoot it, the economy comes down, which is kind of the side they're going to have to lean on. They bring down inflation. Rates are going to be low. They're going to have to keep rates low to turn the economy around. Are they going to go back to pandemic level zero interest rates where the entire economy was shut down? That might not be what they need to do, but they're going to have to bring interest rates down and probably keep them down for sustained amount of time. However, if they're at that middle ground, that balancing act, if they get to do that, then maybe our projections are right. Or if we don't bring down inflation and we don't keep interest rates high for long enough, well, then we got the next 5, 10 years where we're fighting inflation, and interest rates are going to be so much higher than our projections. We'll have to reevaluate it completely there. So we're going to keep you up to date. So just stick in with us, and we're going to tell you when we believe it's all clear. And it's really when the inverted yield curve de-inverts. We talked about that on our last video, about the inverted yield curve. So when we de-invert, and it's all clear for the next 3 to 6 months. We are good. All right, let's move on to our last topic, and that is the housing market. Why is he so confident that that market is, the inflation and the prices are going to come down? Let's listen, and then we'll analyze.
For taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
Okay. And will you be able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will.
All right, before we discuss that clip, if you're finding value from this video, be sure to like the video and subscribe to our channel so you can stay up to date and ahead of the curve. All right, so the question is, how are you so certain that it's going to come down? And what if it doesn't come down? And he says, oh, we're certain we're going to get inflation down to 2%. And housing, the inflation, when they're looking at the data, that housing makes up 30% of the data. So a huge chunk of the data, they have to bring housing inflation, housing prices down, because that's what's going to bring down the inflation. That's what could bring down the data, and that's what they're looking for. So how are they so certain? They'll just keep interest rates higher for longer until the market starts to come down. And we are seeing it slowly throughout the United States. It's just, different regions are on different timelines, different things going on. It's so localized. But as a whole, the United States, the housing inflation and prices are likely going to come down because they have the tools to do so. Stick with us. Expertise you deserve, experience you can count on.